We are going to talk about equities. These two gentlemen are the experts out here. Basically, a lot of cues that we are taking from the US.
Whatever happens in the US, whatever the central bank in the US does, it does have an implication across the world.
Where the interest rate will fall faster, which would be the market.
We always compare India equity returns and US equity returns.
How do you look at the rupee now?
Now the biggest risk for the market is the earnings.
You're fine with the Nifty 50 valuation at this point in time?
Last year was a year of phenomenal earnings growth for mid and small caps, right? Now the tail will start hurting them in the next 2 years is what I think.
Market Thalaivas brought to you by Sundaram Alternates.
So you guys came in from Chennai today morning. Okay. And so what is it that you like about this particular city? I mean, like, if you're visiting this city regularly.
I worked here for around 3 years cumulatively.
Okay. What has been your favorite food from Mumbai?
I love the city for its efficiency.
Okay, efficiency. Okay.
I used to travel by the Mumbai local.
Yeah.
I used to love the Mumbai
Okay.
local.
Now it's more crowded.
It takes around a
Yeah.
week and a half to get used to the crowd. But then,
You like the Mumbai food?
why not? Why not?
Okay. And you?
Yeah, being in capital market,
You keep coming to
you
Mumbai.
have to be in Mumbai. I've stayed in Mumbai. Favorite food is vada pav.
Wow. Okay. So here we go. So we are going to talk about equities. Okay. And these two gentlemen are the experts out here. So what is happening right now in the equity markets is like they're trending high, they are expensive, and there is basically a lot of cues that we are taking from the US, where we are talking about the US interest rate, which kind of defines a lot of capital flows across emerging markets. Arjun, I would like you to kind of give us a base case scenario, how you are looking at what is happening with the Fed and the capital flows that you expect based on the moment of the Fed.
Thanks a lot. Thanks a lot for having me here. It still is the case that if the US sneezes, the world catches a cold. So whatever happens in the US, whatever the central bank in the US does, it does have an implication across the world. We tagged the US, India tagged the US on the way up on rates. We will tag the US on the way down on rates. The most important, I think, to understand at this point in time is from a US macroeconomic data point of view, I think there is nothing that is indicating a recession in the US. I think directionally, US is still holding up. Markets are expecting rate cuts to start by around September. For India, I think it might take a little longer, maybe a couple of quarters, and then probably start end of this fiscal year, probably India's rate cuts will start. Now, from a flows point of view, I think the most important, as all of us know, I think it's the earnings narrative that's very important. So as long as earnings holds up, so your price movement and your earnings movement are pretty much the same. So for example, if you look at mid-cap, the mid-cap has gone up by 65%. Earnings have also gone up in that fiscal year by around 60-65%. As long as the earnings holds up, earnings growth holds up, I don't really think there should be a concern around valuations. There shouldn't be a concern around flows to a certain extent. Now, what can disrupt flows? What can take away that oomph from an India flows point of view? I think there are two things. One, any concern, any disruptive concern from a global growth point of view can take that. We can't see anything at this point in time. The second is China. So we've been saying for a while in the sense that if China inflation starts picking up, then from a valuation point of view, China is at 8-9 PE, very attractive. But it's very low for a reason, for the sense that growth hasn't really come through, and that is the reason why it's fairly low. If inflation starts picking up in China, and if they do something very drastic, probabilities are very low, but nevertheless, if that something turns there, then I think India flows can be impacted. I think these are the only two reasons we can see where there's a disruptive India impact on India flows. Both of these, I think we see very low probabilities at this point in time.
But suppose like if you have to invest in, say, US treasuries and India treasuries, like, if you have to bet where the interest rate will fall faster, which would be the market?
Okay, let me answer this question indirectly. We always compare India equity returns and US equity returns. If I look at a 20-year CAGR of India returns in USD terms, we have delivered 12%.
Yeah.
US has delivered, in USD terms, US has delivered 8.5%.
Yeah.
So in USD terms, we are, despite the fact that our currency has depreciated, etc., despite all of that, we are still much higher than the US from a longer term return standpoint. So I think I'd argue the case, if you're in the market for a longer period of time, I'd argue the case always stick with India.
Same for equities and same for, I was specifically talking about treasuries, actually speaking.
So treasuries, again, I haven't really looked at long-term data on treasuries. I'm largely a liquid equity.
Because considering the fact that the US interest rate moved up from 0 to almost 5, and the probability of them actually say coming back to 2.5% is far, far higher as compared to the...
Let me give you two numbers here. So a few months ago, we were at 7.3 on the India 10-year.
Yeah.
From 7.3 to 7, it was largely India domestic factors that really brought it down. From 7.3 to where we are at around 685, 682, it's largely been US 10-year. So if US 10-year starts moving lower, if your interest rate cuts in the US are fairly steep, you will see the same thing happen in India as well. So the only thing that you will have to factor in is on the currency angle. Because as long as currency doesn't eat away the money that you make in yield, I think India should also be a good destination.
So how do you look at the rupee now? Basically, the rupee has really come down.
Okay, so that's an interesting question. I'll give you a very short answer. It's a fairly long answer as well. The rupee, I think, is fairly stable at this point in time. But one has to understand that if I look at a 30-year average depreciation of the rupee, it's around 3.5% a year. Annual depreciation is roughly around 3.5% a year. Any year where it doesn't really happen, there generally is a catch-up that happens in the years ahead. I don't think that catch-up will happen this year. The catch-up is pending because there's been a fair bit of a pickup in India's services exports, especially in the GCC segment. You have a lot of data centers coming up, a lot of investment coming up there, and a lot of flows coming there is sort of holding up the rupee to a great extent. So maybe in FY25 we don't really see, but FY26 I think that depreciation will start playing out, but on a gradual basis. I don't think there is any risk of a sharp depreciation from the rupee anywhere in the near future, at least in this fiscal year.
Okay. Madan, what is your outlook for equities?
I'll start with where Arjun was highlighting that. See, given the way market has rallied now, the biggest risk for the market is the earnings. But if you look at the long-term story for India, given the government's initiative on the import substitution manufacturing space, long-term story looks much stronger. Earnings outlook from a long-term perspective of 10 to 12% for Nifty looks very much doable. But near-term, there seems to be a earnings miss very clearly. Most of us are talking about a 15% sort of an earnings growth. First quarter numbers, it was flat. There was no growth in Nifty. And adjusted for losses of OMCs, it probably was 8%. So we are looking at a possibility of 15% expectation coming down to 8%. Next year also it can continue because banking, if there will be a rate cut, the banking sector will go through an earning compression again. And banking forms 30% of the index, so if there is earnings compression there, you might see another year of 8% sort of a growth. If 2 years of single-digit growth, can this have an impact on the valuations? That is the biggest question. Probably flows will continue to come because we are structurally seeing India flows happening. And whenever there is a correction, there is a support from the domestic flows. Beyond a particular level of correction, even FII flows are coming and supporting some of these stocks. So I think there is a mid-cycle earnings correction that is likely to happen, which can potentially challenge the valuation at which the Indian markets are. This is on the Nifty side, but on the mid-cap side, I clearly see a lot of froth getting built up because of successive inflows coming into the mid-cap space. It started with FII investments post-COVID due to easy liquidity, followed by passive flows, and followed by domestic inflows, particularly to mid and small cap. They have made almost mid and small cap as large as large cap. And of late, there has been a lot of thematics. And most of these thematics are focused on mid and small cap sectors. So a segment which has seen continuous 4 levels of flows, you can't sit at 40 times multiple. If I exclude banks from mid-cap valuations, if you take Nifty mid-cap, it is 35 times. If you remove banks from it, which are generally single-digit or mid-teen sort of a PE valuation, then mid-cap is trading at 40 times multiple. It is already trading at almost 100% premium to Nifty. Or if you adjust the banks from Nifty, it is almost trading at 75% premium.
But
So you can't sit at there and argue that mid-caps and small-caps still look very attractive. There, I think the investors coming in there at this point of time run a risk of probably not losing money, but they may not make more than a deposit return in next 3 years also.
But you're fine with the Nifty 50 valuation at this point in time?
I don't see a large drawdown in Nifty or risk. The risk, which is unknown, probably might come from the end carry trade, which is some data which I look at. It's almost a $1 trillion sort of a trade, which has got built up in a very short period of time, in last 2 years or so. Only half of it seems to have wound up. No data to prove this, but some of the international reports suggested. Remaining half can wind up as and when US enters into a recession and Japan's inflation keeps going up. Thereby the magnitude of interest rate reversal in both the countries can be significant. If that happens, that can keep on limiting the upside to an extent. So that's what I see. So probably not a big drawdown, but upside seems to be limited across the 3 cap curve segments. One for valuation and another due to earnings.
And what about key risk out here?
Key risk, again, as I said, so what has happened in the mid and small cap is a lot of, you have to go back, as Arjun was saying, last year was a year of phenomenal earnings growth for mid and small caps, right? He was saying 60% sort of an earnings growth, which is what we've seen. But we have to understand a lot of it came from the commodity tailwind. Post-Ukraine war coming to some sort of a stability in supply chain globally, you had a benefit of commodities falling sharply. And given India growth story, a lot of companies were able to maintain the price. So margin expansion led to a 60% growth in mid and small cap space. But if right now we are seeing even mid and small cap space, earnings are being in single digit. So can they continue to, and we are seeing consumption is definitely on a weaker note in India. Manufacturing is in a good foot, but manufacturing last year benefited from margin expansion as well as top line growth, which seems to be now behind you. So we are we did some numbers. Last year, 70% of the index had more than 20% growth in terms of earnings. In the first quarter, this number has reversed. 70% of the index companies are having less than 10% sort of a growth. Okay. So that is the biggest risk I see. Not a drawdown sharply, but probably for 3 years, if somebody is investing in index or the large diversified portfolios, they run a risk of making single-digit return for a very long period of time.
And what are the key sectors that you feel are very attractive at this point in time?
So, see, we look at ourselves as an extension of PE rather than an extension of mutual fund, although our parent is a mutual fund. We start a lot of our research from sectors where the PE deals are very active, actually. I'll give you certain sectors where, or examples, what we have done in the last 5 years or so. If you look at one of the sector where we have made a lot of money is consumer discretionary, which is also highlighted in the report.
Yes.
In the report that consumption is one of the focus areas for the family offices as well. The reason I think it is in the family office sort of universe is these are high growth sectors, particularly consumer discretionary is a high growth sector. I was just seeing a number, one of our key investment Trent. This company has moved from 25,000 crore market cap to 2,50,000 market cap in less than 5 years. Asian Paint, which is another big performer, but it took 10 years for Asian Paint to achieve this. And Unilever took some 20 years to achieve this, to move from a 25,000 crore market cap to 2,50,000 crore market cap. So why this happened? In a short period of time, Trent has grown almost like 35% CAGR.
Yeah.
So our research also starts by looking at those long-term trends and companies within those long-term trends where the growth can be substantially higher than their peers. And consumption is one area, consumer discretionary particularly. Consumer staples are, in our opinion, fairly penetrated and don't see much of value there. Consumer discretionary looks very interesting. Another area is where our parent is also in the business, which is NBFCs. We feel that that's a value zone right now in the market. Because if you look at some of the small ticket NBFCs, they have not gone up too much because of the increasing interest rate scenario, margin compression, and followed by some of the unsecured loans being in a higher credit cost being there. The NBFC space banking has not done well, and NBFC says particularly despite growth has not done well. And a lot of those stocks are at a good value zone at this point of time. These are companies which are capable of growing more than 25% loan growth by being present in particular geography or a particular product, and then eventually moving out of that geography to other states, or moving from one product to other products, like what typically Bajaj Finance did over the last 10 years. I think Chola did it in the last 5 years. Right now we see 2-3 other companies doing it. So we are looking at that space, and that space in my opinion looks like a pretty good value bargain in the scenario. And if what Arjun says translates, that there will be a rate cut, you can easily go short on banks, buy NBFCs, because the reverse flow, because banks have almost 70% of their book linked to repo rate. If there will be a rate cut, you will see margin compression there and margin expansion in NBFCs, and growth will also be much superior in NBFCs compared to banks. 30% of your banking in the index. This is a very good trade that I think from a 2-3 year perspective investors are getting. Third area is technology. We are investors in Zomato right from 50 rupees, and also some of the international mid-cap space in the ER&D areas. So these are 3 large segments that we are focusing on.
And Arjun, what is your view basically about taking a call on, say, investing in the US market, US equities, considering all the macro things that we spoke about?
So like I said, I think 20-year CAGR, India beats the US in US dollar terms.
Yeah.
So I'd still say stay with India, because at the end of the day, we're an emerging market. Emerging market returns will always be, directionally, we will tag the US. There is no two ways about it. For the last 25 years plus, if you just plot a simple chart, year-on-year chart of S&P 500 and Nifty, they move exactly in the same direction. So the directionality is very clear, but outsized returns will only be in India. The only thing that stands between these two is the currency. So as long as the currency is stable, and there will be a depreciation, we are an emerging economy, we are a net importer. So as long as the currency depreciation is managed, it stays within that average 3.5%, I don't think we should really be worried about. I think staying with India makes sense.
One point on which I was just doing this number. Sorry, I was just doing this number. It's an interesting aspect which was put forward by BlackRock long back, which is coming to play in India right now. If you look at US were able to handle a lot of this financial crisis later on because the market cap to GDP was much higher. This is probably a country which has such a large amount of capital lying, which can take the credit shocks very easily. India has almost reached that stage with the recent rally. India's market cap to GDP is almost like 1.5 times. A 3 trillion market, we are almost like 5 trillion in terms of in the market cap. Our ability to take credit shocks will be much superior going forward. So this almost gives a lot of comfort for foreign investors from a long-term perspective to come in, which is a very positive thing that has happened. Structural change, I would say, not just from the capital availability, but also ability of the country to take credit shocks in the short term.
So final question, what are the sectors or segments to avoid?
Okay. Segments to avoid, I think wherever recently money has been raised in the form of thematics, I think just to give, I might sound very contra view.
Yeah.
Defense companies which have been raised in the last 2-3 months, trading at 60-70 times, funds collecting them, and then if I look at their earnings, they can deliver a 15% growth maximum, but if you're really looking for a 25% growth, it will not be a very widespread sort of area where you can make so much of earnings growth. But all of them trading at something like 55-60 times. If India's defense budget itself is increasing only 10%, aggregate of all defense companies going up to 25%, there is something not matching, right, in my opinion. So I think these are areas where narratives got sold out too fast and in a very short period, and flows also supported these narratives. I think those are areas where you might end up not making money for a long period to come. Same is with some of the manufacturing funds launched in the recent, probably they have bought some of these capital goods companies at 60-70 times. We used to argue against Nestle just before COVID, right? That Nestle at 60-70 times, where is the value? We are looking at a lot of capital goods companies at that level at this point of time. So there should be a diversified approach towards investment. I think there are good opportunities in consumption as well as in the manufacturing, as well as in the tech side. I think that kind of a diversification is very important at this point. Valuations won't be cheap, but if you get a company fairly valued with a very good earnings growth trajectory, then I think that's a safer zone to be. Large diversified portfolios, they got benefit from the tail in the last 2 years. Now the tail will start hurting them in the next 2 years is what I feel.
That's it, gentlemen. Thank you.